Welcome to the Stocks channel. My name is Cory, and today we're going to use objective technical analysis and data to explain why the stock market can continue to go higher from here. So we're going to be taking a look at the S&P 500 SPX index, and we're going to be looking at a weekly chart. So let's go ahead and crack open this chart. Alright, the first thing we want to take a look at is the price action. So last week was a red week and we did cool off a little bit, but that price action is still over the 5 EMA. Remember, this is a weekly chart, so every single candlestick on this chart represents an entire week worth of price action. So looking at these candlesticks, we still see very bullish price action still closing over that 5 EMA. We still have a very strong bullish trend because all of these moving averages are positive sloping and they're all stacked to the bull side. When I say stacked to the bull side on the moving averages, I mean that the faster moving averages are above the slower moving averages. So the 5 is over the 13, the 13 is over the 20, and the 20 is over the 50. This is what a bull market looks like. All of those moving averages stack in a nice upward sloping trend and they just continue to rise week after week. You can see a couple of weeks ago the price action was getting a little too far extended and we did close over the upper Bollinger Band. Typically speaking, when we go over the Bollinger Band, we need to retrace and cool off a little bit, and we did see some selling last week because we got a little too far too fast. But now that we've cooled off and we see the Bollinger Bands continuing to expand, that means the stock market now has more room to run. So when we have bullish price action and we have bullish trending and we're not overbought, we don't get bearish on this market and we don't try to call a top. We're being 100% objective and we're looking at the chart from a weekly standpoint and we're seeing that we have bullish price action and bullish trending. And we also see that we now have more room to run. And starting this week coming up, we know these Bollinger Bands are going to continue to expand and give us more room to the upside. So that's the technical look at the price action and the trend, and we see that both are bullish. So let's take a look at some other data and see how that could also factor into a bull case for the stock market. So the first thing I want to take a look at is a chart from Macro Charts, and you can follow Macro Charts on Twitter, and you can see right here is their handle at Macro Charts. And they have this chart that shows the US Equity Sentiment Indicator, which essentially means it shows if investors are bullish or bearish on the stock market. So right now, a lot of question on people's mind is that there's a lot of greed in the stock market, therefore the stock market can't head higher. This chart shows that that is exactly the opposite of what's possible. We see extreme greed back here on December 10th, extreme greed back here on February 13, and we also see extreme greed in all of these other cases as well. So when we look at when we have extreme greed, we see the stock market can continue to head higher here, continues to head higher here, continues to head higher here, and doesn't continue to head higher here. And then again, it continues to head higher here. So out of all of these cases where we've seen extreme greed, only one time did the stock market not continue to head higher. So looking at the data, there's no way you can say that the extreme greed now means that we have to go lower. If anything, the data's on the side that we're likely to continue to head higher. So this one chart really doesn't give us any answers. It just shows us that there's not a good chance that we have to head lower just because we have extreme greed. So it's good to know that looking at history, this extreme greed indicator doesn't necessarily predict any stock market selling. So what else can we look at to see if the market is likely to head higher or lower? Well, we can look at the S&P 500 positioning for retail traders, and we know that retail traders are typically wrong. So what are retail traders betting on for the S&P 500 right now? We have retail trader data shows that 41.19% of traders are net long. Therefore, there's only about 40% of retail traders who think the S&P 500 is likely to head higher. So if we look at the bear to bull ratio, we see that we have 1.43 bears to every one bull for the S&P 500. While we do have extreme greed, it shows that there's not extreme greed in the S&P 500 broad indices. We do see extreme greed across the board in the stock market, but that shows that the stock market doesn't necessarily have to go lower just because we see greed. Most people are following the price action and following the trend, therefore they're being greedy while the market is a bull market. That's exactly what I want you all to be doing. While the stock market is heading higher, I want you to be making money. I don't want you trying to short or not be in the market while it's continuing to head higher. There will be a time to short and there will be a time to go to cash, but right now it still doesn't look like it's time for the stock market to sell off in any meaningful way. So looking at this sentiment here, we see there's a lot of people shorting the S&P 500, which means there's a lot of cash and there's still a lot of short squeezes that can continue to drive the market higher. When everybody's in the market, that's when the market will sell off because there's no longer any cash left on the sidelines. So let's go back to this macro charts chart that shows us how much cash is on the sidelines. We still see that there's an extreme amount of cash on the sidelines, and as the S&P 500 continues to head higher, there's still a lot of people that are getting fearful and they're worried that there's too much greed, so they're selling and they're going to cash or they're trying to short this market. So I've showed this chart in the past, and basically it shows that when there's a lot of cash on the sidelines, the stock market continues to head higher. So the more cash we have, the more people there is to eventually FOMO into this market to drive it higher. A lot of cash on the sidelines is extremely bullish for the stock market. Just like any market, we need people that'll buy in for the market to continue to head higher. If everybody's already in the market and there's no cash on the sidelines, it's more likely the stock market will head lower because there's more people that can sell. So we see a case where there's more bears than bulls on the S&P 500, and we've already showed that the extreme greed doesn't necessarily mean that the stock market has to sell off. And now I've showed you that there is a lot of cash on the sidelines, so we're more than likely going to see people FOMO in at the top, continuing to drive the stock market higher. We're also going into the Santa Claus Rally, where we're going to get a low volume melt up, where retail investors are just going to slowly start buying in as the stock market heads higher. And there's really not a lot of big money managers doing a lot in the month of December. They're all packed up and they've gone home for the holidays, and they're getting ready for Santa Claus to come to town, and all of the bears are hibernating. There's not a lot of money that's going to be leaving the stock market in December because we're following the money right here, and we see there's already a lot of money on the sidelines. So I hope that makes sense, and I hope that helps you understand why there's a good chance the stock market will head higher. With all of this cash on the sidelines, it's more than likely people will be buying in, and anybody who already wanted to sell their stocks has already sold at this point. So going back to the S&P 500, we see we have bullish price action and bullish trending. We do have extreme greed, but I've already showed that that doesn't guarantee we need a sell-off. And I've showed you there's a lot of cash on the sidelines, which means there's a lot of people that can still buy into this market, driving it higher. Remember these trend lines that go back to 2009 and 2018, and we're now breaking above that trend line, which anytime you break above a resistance trend line, that is a bullish sign. We've now broken above resistance, which could be newfound support. So it's very likely the S&P 500 is going to continue to head higher and bounce off of this trend line as support as we reach my next resistance level at 4,040. Now, it doesn't mean we got to get to 4,040 in a hurry. There could be a lot of volatility and we could go up in a very volatile fashion, but the VIX is also heading lower, which means we're likely going to see less price swings and just a slow sort of grind higher melt up market. So looking at the chart, looking at the technicals, and looking at all of the data, it's more than likely the stock market will continue to head higher. Does that mean we won't see any selling on the way there? Absolutely not. There's always going to be some selling in any bull market, which is healthy and is expected. So we did see some selling last week, which to me is a bullish sign because that means the market now has cooled off a little bit and we finally have some more cash on the sidelines as people position themselves for more selling. If that selling does not follow through, eventually those people are going to buy in at higher prices, only driving the stock market even higher. So if you follow my daily technical analysis, I do have the S&P 500 going into the 3,700s this year. Now going into next year, we'll follow the chart day by day and week by week, but it does look like we're setting ourselves up for a secular bull market for 2021. Remember, this crash is in a lot of people's minds because it's recently happened, and a lot of people are using hindsight bias and they're thinking that another crash has to be coming because it was a very recent event. But the stock market doesn't typically crash 2 times in a short amount of time. So we've already had a bear market, which was the shortest in history, only taken 1 month to reach a bottom. And now we're heading back into a secular bull market, which is very apparent if you look at the trend and you look at the price action. Ever since the crash, we've had that 5 EMA cross back over to the bull side, and it's stayed over the 13 EMA on the weekly chart ever since. This is a bullish sign, and until we see something shift in the price action and the trend, we're going to remain bullish on this market. I do technical analysis daily on the stock market, so if you're new to my channel, you might want to go ahead and smash that subscribe button so you can follow along with all of my daily updates. I hope you all enjoyed this special weekend update of a weekly look at the stock market, and I hope it really helps you all better understand why I'm still so bullish on this stock market. Remember, I'm always going to be objective and I'm always going to follow the price action and the trends over anything else. You can also see the data I presented you goes hand in hand with a bull market. So I hope you enjoyed my special update and I hope you enjoy your weekend. And as always, I will see you all in the next episode.